Good morning, everyone, and a very warm welcome to our Finance Focus webinar for business owners. We're delighted to have so many of you join us today. I'm Mike Dyer, a partner here at Kreston Reeves, and I'll be chairing our session today. For those of you who don't know Kreston Reeves, we're here to help our clients with so much more than just accounting, business, and wealth advice. We support you in achieving your ambitions so that you can reach your brighter future. Before we begin today's session, we'd just like to share an important update about our business. As many of you will already know, Kreston Reeves has recently become part of the AAB group following the completion of all regulatory approvals. This marks an exciting new chapter for our firm, with Kreston Reeves becoming AAB's hub for London and the South East. For our clients, it's very much business as usual. You'll continue working with the same trusted advisors and teams from the same offices with the same commitment to delivering the personal relationship-led service you know us for. What this change does bring, however, is greater scale and capability. As part of the wider AAB group, we're now able to offer access to an even broader range of specialist expertise, enhanced sector knowledge, and additional services across areas including global tax, wealth management, and people consultancy. At the same time, our own strengths in legal services, forensic accounting, valuations, and indirect tax further enhance the expertise available across the combined group. The combined organisation now brings together more than 1,800 people across 25 locations throughout the UK and Ireland, creating a stronger platform for continued investment in our people, technology and client services. We're excited about the opportunities that this creates, not only for our business and our colleagues, but most importantly for you, our clients. And today's webinar is just one example of our ongoing commitment to keeping you informed and helping you navigate the issues that matter most to you and your organisation. So I'll just start with some housekeeping. This webinar is being recorded and a recording will be sent to you all later today. Technology permitting, we'll be asking you for some interaction by taking some polls throughout the webinar so we can share the results with you and generate some further discussion. And there'll also be a pop-up survey at the end of our session today, and we would be really grateful if you could spare just a couple of minutes to provide us with some feedback. So in terms of how to ask a question, we've already had some questions sent in, but please do continue to submit your questions throughout the session by using the question functionality shown on the screen. I'll leave that there just for a moment, just while you familiarise yourselves with the function. So moving on, in terms of our polls, so we have our first poll of the morning, which is, where is your business currently? And if I could just invite people to answer one question or select one answer, just so we can judge the outcome. And we'll just leave that on the screen for a few moments just while some selections come through. We'll just give it a few more moments. So we're up almost to about 80% of voting. So interestingly, 42% of those answered established and stable in terms of current state of the business, and 37% growing and stable. Preparing for session seems relatively low, but that may just be an outcome of where the businesses are in their own particular life cycle, and then obviously a few considering sale or exit. So thank you for the answers to that. That's been very interesting. So it's now time to introduce our panel and to cover the areas that we'll be covering. So in terms of matters covering today, overview of our case study, which I'll outline in a moment, touching on pension changes, inheritance tax planning, the importance of wills and lasting powers of attorney, and some succession planning. And then in terms of our panel, just moving the slides on. So we have Daniel Grange, who is a partner and head of tax, Joe White, partner and head of private client tax, Dante Peters, partner at AAB Wealth, and Gemma Spencer, solicitor, partner and joint head of legal services. So just to introduce the session, as some of you may be aware, just moving on, there've been a number of significant inheritance tax changes introduced from 6th of April 2026, whereby agricultural property relief, known as APR, and business property relief, known as BPR, at 100% is restricted to a limit of 2.5 million per individual, although I would note that this is now transferable, and 50% relief above the £2.5 million limit. AIM shares, alternative investment market shares relief, has been restricted to 50%, and I would note there is no £2.5 million allowance for AIM shares. These restricted reliefs apply to gifts after 30th of October 2024 if death occurs after 6th of April 2026. Trusts have their own allowances of 2.5 million, but there is a wrinkle in that the 2.5 million is shared between trusts created by the same set law after the new rules came in on 30th of October 2024, and pensions currently remain outside of inheritance tax, but only until 5th of April next year, 5th of April 2027, where thereafter they're brought into the estate and will be caught for inheritance tax. So just to introduce our case study, so we have a couple, Bob and Margaret, aged 64 and 63 respectively. They have 2 adult children, Sarah, who's 38, married to Simon, 36, with 2 children aged 10 and 8, and Jonathan, aged 35, married to Katie, also 35, with 1 child aged 5. They have joint assets totaling 9.2 million, comprising their house at £650,000, doubled up to 1.3 million for the joint ownership. Their company Nexora Trading Limited, valued at £6 million, cash of £750,000, plus their pension funds of 1.15 million, which comprises investment and commercial property. In terms of their income, just on the next slide, Bob and Margaret have income totaling £280,000, made up of salaries, trading company dividends and interest, with the breakdown shown on the slide. So I'd now like to pass over to Dante Peters, who's a partner at AAB Wealth, who'll be covering the pensions and inheritance tax aspects, what is changing, issues and some actions. So over to you, Dante.
Good morning, everyone. Obviously, as you can see, talking around pensions. This is a complicated area when you start to get into the detail. So what I'm going to try to do today is just give you a sort of pointers to the areas which you should be considering. Moving on, please. So if we actually look at how things are today from an inheritance tax perspective, as we sit here today, pensions are not subject to inheritance tax, but are subject to income tax in various circumstances. Key dates are always whether someone passes away before or after age 75. Broadly speaking, if someone were to unfortunately pass away prior to age 75, most of the benefits in their pension are free from tax. Post 75, things change and income tax is then chargeable. And really, post April 27, what we have is that inheritance tax becomes chargeable on pension funds. Can you move on, please? I think the important thing is to look at, well, when it comes to inheritance tax, there are areas which are what we call in scope and out of scope. And I think the most important thing from an inheritance tax perspective is looking at who is actually out of scope, i.e. inheritance tax is not chargeable. And I think the most important things to realise here is if you are passing on pensions to spouses, then they are exempt from any inheritance tax on pensions, and there's certain types of pension benefits but also out of scope. Next, we move on, please. I think one of the most important things which people need to consider is their expression of wish. And what an expression of wish allows is for personal representatives and pension providers to consider to whom the funds can go to on the death of members. And I think the key point here being that the transfer between spouses or those in civil partnerships will remain inheritance tax exempt post April 27. And as we sit here now, what many people have done is where they will have multiple different beneficiaries potentially under their pension schemes. And what I think it's important to realise is that you should be reviewing your expression of wish now with a view to thinking, what am I going to do when it comes to April 2027? There are certain areas you need to be aware of. That it's been quite common for people to put something called a spousal bypass trusts. into pensions. Got to be careful with those. Effectively, of course, they will fall well, be subject to inheritance tax. So I think the key message here is make sure that you review those expressions of wishes as soon as possible. And then actually what you want to then do is action that change as soon as possible when we get to April 2027. Moving on. I'm only going to briefly cover this area. Of course, it will be covered in more detail in later parts of the presentation, but I think it's just key for people to realise that there are different ways with tax can be paid. You can actually pay the inheritance tax on the pension from the wider estate, not necessarily from the pension. It can be paid direct to HMRC from the pension, and it can be paid by beneficiaries after they've actually received the pension funds. I think the key point here is to remember that the personal representatives and the beneficiaries are jointly and severally liable for paying that tax. And one of the areas which we're concerned around as planners is that a beneficiary receives the pension, doesn't realise there's tax to pay, and then obviously spends the funds, and then that obviously causes potential issues. So it is going to be possible for the personal representatives to apply a withholding notice, the pension provider asking them to retain some of the actual tax which is due. So if we're moving on, please. And I think the other thing which everyone needs to be considering, and this really doesn't really matter, even under current rules, it's always important to be thinking about, well, okay, in the event of my passing, how is my money going to be distributed to my beneficiaries? Is it going to be a lump sum payment, or is it going to be that we continue with money inside a pension? And there's pros and cons of both. If money stays inside a pension, which is what we call beneficiary drawdown, the advantage of that can be that it can delay future tax payments, and also it actually does allow the funds to remain in pension schemes, which in some cases can be beneficial from factors that the tax relief on pensions and growth is obviously maintained. Moving on. I think these are the issues which do need to be considered. I think it's obviously your personal representatives, they just need to be up to speed with their obligations and how complicated this area can be. And I think the question which everyone needs to ask is, in many cases, it's loved ones who end up being your personal representatives and being executors of your will. Is that something that you really wish on your loved ones? Got to carry out a role like this in a time of grief. The other things we see as planners is it's family dynamics. It's the tension between beneficiaries. And we can see that where beneficiaries differ between the pensions and the will, the way the tax is potentially applied could lead to all sorts of disagreements. And obviously that's obviously with personal representatives, so obviously family members. It is complex on how, there's a number of options on how tax should be paid to HMRC, and the careful consideration needs to be taken to make sure that you are paying it in the most tax efficient manner. I think the other issues which we're certainly going to see is that pension providers will not be able to cope with the new rules. At the moment, what we're seeing is typically for many pension providers, when they receive a death notification, it's taking them about 87 working days, typically is the average, to get benefits paid. We can certainly see that it could take considerably longer, and there are rules around effectively where you've meant to be making payments within 6 months. And we feel that it's unlikely that many providers are going to be able to meet these deadlines. I think the other thing to remember is that the more pensions that you have, the more there are to value. And some pension providers, as I say, their systems are legacy systems, and they will really struggle to get you the valuations in a timely manner. Other issues which you should be thinking around is illiquid assets. What I mean by that is, do you hold commercial property inside your pension? And what were to happen if you were to pass on to that commercial property? And I think the other issue it's around the expression wish. Make sure that they are correctly completed. Moving on, please. So, well, what can you do? From my perspective as a financial planner, I think the most important thing I can always say to you is make sure that you have a plan that is linked to your life goals and linked to money. So what I mean by that is, have you priced up your life? Do you know how much your life is going to cost? And then make sure you have a plan that delivers what you need to live the life that you love. The other things, well, simplify the number of pensions and just generally try and simplify for your life where possible. Any form of a liquid asset, have conversations. How would that play out in the event of your passing? Speak with your personal representatives and beneficiaries, and make sure that people understand what your wishes are on your passing. Other areas to consider around pensions is increase your spending. We spend most of our time saying to all our clients, please spend your money. No one should be the richest person in the graveyard. You can do other things, make gifts out to regular income. You can use life policies to cover inheritance tax liabilities. It may be, in some cases, exploring purchase of an annuity to reduce the value of your pension fund. The other thing is also consider third-party pension contributions for adult children and your grandchildren. What I mean by that is that you can make a pension contribution on their behalf. We see that many of our clients' adult children, though may have good earnings, also have high expenditure. So it means they're not maximizing their pension contributions. And it means if you have to take some money out your pension and get taxed, it's at 20 or even 40%, but you have a child who gets tax relief for 40%, it's pretty much tax neutral. I think the other keys are have an up-to-date will, and always keep your expression of wishes up to date. Anyway, that's enough from me. Mike, back to you.
Thank you, Dan. So as you say, there's a number of issues there to consider, and it's likely to be a significant practical issue for pension providers, particularly given there's less than a year for them to get ready. So I'd now like to invite Joe White to join, who's going to be covering some inheritance tax planning. So Joe, over to you. Prior to that, just a brief reminder about how to ask a question. So please do keep those questions coming in.
Thank you, Mike. As Dante has confirmed, from the 6th of April 2027, the value of any undrawn pensions will be subject to inheritance tax on death. For some, not only does this mean that an additional 40% inheritance tax will be payable on the value, but there is also the potential for the loss of the residence nil rate band, where the pension tips a taxable estate over £2 million. Those in this position could see an effective inheritance tax rate of 60%. For Bob and Margaret, as their gross estate value is already above 2.35 million, any residence nil rate band which would be available for passing their home to their direct descendants is tapered away to nil. The result of this pension change therefore means their estate's inheritance tax position will increase by £460,000. Moving on. As Mike explained, Bob and Margaret's pension currently includes a mix of investments and property. The property is commercial property, which is used for their trading company. Had the property been owned in the company, then its full value would likely be eligible for business property relief at a rate of 100%. Alternatively, where the property is held by them personally, a 50% relief will be available. This is providing they also are controlling shareholders of the company. Under the current rules, the value of the property contained within Bob and Margaret's pension is completely tax-free. However, from the 6th of April 2027, the full value becomes taxable on second death due to business property relief not being available to pensions. This means a potential loss of £100,000 of tax relief based on their other assets. One option Bob and Margaret may wish to consider is transferring the property from the pension to them personally. Providing they hold the property for a period of at least 2 years and they maintain their controlling shareholding in the company, a tax saving can be achieved. To do this, they need to consider two options. The first would be a distribution of the property as a pension payment. However, this would trigger an income tax liability of £225,000. Given that Bob and Margaret have cash funds of £750,000, the better option for them might be to purchase the property themselves. Whilst this will lead to a stamp duty land tax charge of £14,500, there is no further tax to pay by the pension. By taking this proactive step that I have just walked through, Bob and Margaret will have more liquid funds available to them to help manage their income more effectively in the future. As they are shareholders and directors of the company, they have control over other sources of income that they can extract. Instead of extracting monies from an asset which qualifies for business property relief, they could instead look to take monies from their pension. Based on the current underlying income tax rates, Bob and Margaret would pay a slightly higher income tax charge in extracting pension as opposed to dividends. However, they need to balance this with the inheritance tax saving of reducing the pension value and increasing the value of a business property relief qualifying asset. Whilst this option can create an inheritance tax saving, it is worth noting two key points. First, there needs to be sufficient assets and income available from the pension. Seeking financial advice ahead of implementing this plan is therefore recommended. And secondly, if the company retains excess cash which cannot be shown as having a business need, then a restriction to business property relief could arise longer term. It's really therefore important that as directors, they monitor the cash balances alongside the business needs to ensure that this strategy does not have a detrimental impact on their wider estate. Another option that Bob and Margaret could consider is the use of the regular gifts out of income exemption. Where set up correctly, regular gifts can be exempt from inheritance tax rather than falling within the 7-year rule. In order for these gifts to fall under the exemption, they need to be made from surplus income, form part of your normal expenditure, must not affect your normal standard of living, and form a regular pattern of gifts. Once the pattern has been established, it is possible to switch off, pause, or increase these gifts and still fall under these rules. It therefore presents a very flexible way of managing inheritance tax longer term. It is worth noting that income generated from an ISA can count towards income for this purpose. There is often a misunderstanding of what is classified as expenditure when assessing surplus income each year. It is therefore really important to understand these categories of expenses that HMRC will seek evidence for. In addition, your financial needs will change year on year, and therefore what may be surplus income in one year may not repeat itself subsequently. When looking to use such exemptions, it is worth maintaining good records of both your income and expenditure, as your executors will need these in order to make a claim with HMRC. For Bob and Margaret, we see there being two viable options. The first is to use their existing surplus income. Bob and Margaret have confirmed that their day-to-day living expenses are lower than their income, with any surplus income being added to their annual savings. To minimise the build-up of cash reserves longer term, they could set up a regular pattern of gifts to their children or grandchildren. As an example, gifting £10,000 of surplus income per annum can create an immediate inheritance tax saving of £4,000. As Bob and Margaret have not used this exemption before, we would advise that the initial gift is made alongside setting up a regular standing order. Further, we would recommend that the intentions of these gifts are documented in writing to support the exemption being relied upon. Bob and Margaret have young grandchildren, so they may wish to use these monies for supporting educational costs or putting into savings accounts or pensions for the future. The second option is for Bob and Margaret to either extract additional monies from the company, either by way of salary or dividends, or from their pension. This needs to be considered alongside the cash reserves available. If we were to assume an additional £25,000 of pension income is drawn, then they would have £13,750 of surplus income to gift. The full reduction in their pension would be immediately outside of inheritance tax through the surplus income exemption and the payment of income tax on its extraction. Whilst there is an income tax cost to this strategy, as Dante has already said, should they die after 75, their beneficiaries would also suffer income tax on the monies extracted in the future. Bob and Margaret should therefore consider this as an acceleration of tax payable, coupled with the benefits of less inheritance tax payable on death. And I'll hand back to Mike.
Thank you, Jo. As you've highlighted, there's some potentially sizable inheritance tax savings with some planning that can be achieved. The downside, obviously, is the need, as always, for record keeping. So just another reminder, please do keep your questions coming in. As I say, the instructions are on the screen there. And then we'll just move on to our second poll of the morning. So again, when do you anticipate stepping back or exiting your business? And if you can just select one of those answers, we'll just leave that up on the screen for a short while, just while some of the votes come through. Just give it another couple of moments. Okay, so it looks like the majority is no current plans. The rest is a fairly even spread between 2 to 10 years. So again, thank you for that. We'll just move on now. So I'd like to introduce Gemma, who is going to be covering the importance of wills. Gemma, over to you.
Thanks, Mike. So in our case study, I meet with Bob and Margaret together with Jo so that we can review their wills as part of their estate planning process. They're keen to understand what impact the new provisions will have on their estate administration and what extra responsibilities will be placed on their executors so that they can decide who would be best for the role. Their executors will need to make contact with the pension scheme administrators as early as possible following death to establish the value of any unused pension fund and death benefits payable for inheritance tax purposes. Meanwhile, their executors will need to value the rest of the estate. If the estate involves an interest in a business, that business will need to be valued, and any property or properties owned by the business or the pension fund would have to be valued. The executors also need to identify whether any gifts or chargeable lifetime transfers have been made in the 7 years prior to death, and whether the deceased benefited from any trust at death. All of these factors will make up the total gross value for inheritance tax purposes. It's probably at this stage that the executors should consider submitting a withholding notice to the pension scheme administrators if there's a chance inheritance tax will be payable on the pension fund. The executors will need to identify all the reliefs and exemptions available. They should then contact the pension scheme administrators to ask for the mix of exempt and non-exempt beneficiaries once a decision has been made by the pension trustees. Only then can the executors calculate the tax due and apportion that amongst the different funds so that they can arrange payment of the tax. And oh yes, they've got to do all of this within the first 6 months from death if they want to avoid paying interest on the tax due. Let's not forget, this isn't likely to be the executor's day job, so they'll be having to do all of this in their spare time whilst also grieving for the loss of a loved one. It's only once all of the above steps have taken place that the inheritance tax forms can be submitted in order to make an application for probate. You can see there is quite a lot that your executors will have to do, but there are some things you can do to help. Keep a list of where your pension funds are and how to contact the pension scheme administrators. I would also recommend you keep copies of any nomination forms submitted so that your executors are armed with as much information as possible at the outset. I've listed on this slide some of the things to consider when deciding on your choice of executor. If you're thinking of having more than one executor, it's important that they can communicate well and make decisions quickly, as any strain in the relationship between executors could cause delays. Also, consider whether executors who are not resident in the UK are suitable, given that whilst a lot of paperwork can be processed online, there will still be some forms that require wet signatures. Bob and Margaret are planning to leave their combined estates to their children and ask if it's possible for their children to be both beneficiaries and executors. They absolutely can, and in many ways it makes the most sense, as a beneficiary will be incentivised to crack on with the job and be rewarded for all of their hard work. When I look at their wills with Bob and Margaret, they're surprised to discover their executors are Bob's brother, who retired to the south of France several years ago, and Margaret's old school friend, who sadly passed away last year. Given all that has been discussed and the additional responsibility placed on executors, they agree that their children are best placed for the role. I encourage Bob and Margaret to read through the remainder of their existing wills to make sure they're still in accordance with their wishes. On this slide, I've set out some potential pitfalls with wills where estates could face unintended consequences from April 27 onwards. I've given a very simple scenario on screen to help me to highlight the point. Here, let's assume we have a pension passing to grandchildren and a tax-free sum passing to the children, with the remainder passing to the surviving spouse. Perhaps it's a second marriage and the individual concerned would like their family to benefit while still making suitable provision for any surviving spouse. It looks quite straightforward, and that's because it is, if the person dies before next April. Fast forward to next year, and we'll have to check the wording of the will to see who gets what. If the gift to the children is the maximum sum I can give tax-free, then the children will receive nothing, as the entire nil rate band will be used up against the pension passing to the grandchildren. If, however, it's a fixed sum of £325,000 stipulated to be a tax-free gift, then the nil rate band will be apportioned between the pension and the tax-free gift. The part of the gift subject to tax will then have to be grossed up and the tax paid out of residue, so that the children receive their fixed sum of £325,000, but additional tax will be paid out of the part of the estate passing to the spouse. We also then need to consider who pays the tax on the pension fund. Most wills will have a clause in them specifying that any tax payable as a result of death is paid out of the residuary estate. This is a catch-all clause that's designed to help executors access the funds to pay the tax rather than having to go cap in hand to beneficiaries who may have received a gift 6 years earlier, unaware that the tax could one day have to be paid on the gift. This clause will mean the surviving spouse ends up paying the tax on the pension and may end up with very little, if anything at all, from the estate. I also wanted to highlight here how the rules will impact those individuals intending to give 10% to charity to enable the tax-paying part of their estate to qualify for the reduced rate of inheritance tax. What we've been told is that the pension fund will now be considered as part of the general component when calculating what that 10% gift to charity amounts to. For simplicity's sake, let's assume we have an estate worth £1 million and a pension fund worth £1 million. The 10% gift to charity would currently amount to approximately £100,000, leaving £900,000 to pass into residue. Come April 27, that same provision would increase the legacy to £200,000, leaving just £800,000 left in the estate to pass to residue. I'm conscious this next slide might not be applicable to many people watching today, but I think it's worth pointing out as we haven't said much about the residence nil rate band. This is a relief applicable to people who leave their residence to their direct descendants on death. It enables the first £175,000 of that property to pass tax-free and is transferable between spouses, enabling couples to save up to £140,000 in tax. However, as Joe's pointed out, the relief is tapered away by £1 for every £2 a person has over the £2 million mark. With pensions being included in the value of people's estates, fewer people will benefit from this allowance. There will be some couples who currently sit comfortably within this threshold, but will be in danger of losing this relief next April when their estates are combined on second death. These couples could consider including nil rate band discretionary trusts in their wills to ring fence £325,000 on the first death. This could allow the surviving spouse to still benefit from those assets without them forming part of the survivor's estate for inheritance tax purposes, which might just enable them to stay within the £2 million threshold and save up to £140,000 in tax. And why stop there? Now is the time to give all of your important documents a health check as part of the estate planning review. If you are a partner in a partnership, do you have a written partnership agreement in place? Does it cover what happens on the death of a partner? Are there enough partners for it to continue? If you're a director and shareholder of a company, do you have any restrictions in your shareholders agreement about who can inherit the shares? Do you know what your articles of association say about the death or incapacity of a director? And finally, if you haven't already got them in place, please consider lasting powers of attorney. Many people wrongly assume they're only relevant in old age and think they will always have time to put these documents in place. Powers of attorney enable you to choose the person you trust most to step into your shoes and make decisions if the day should come when you cannot do so for yourself. Whilst this might be due to an age-related illness, it could just as easily be due to an accident or unexpected illness at any age. Sadly, none of us has a crystal ball. We don't know what life has in store for us. Lasting powers of attorney could be the most vital insurance policy you ever take out.
Thank you, Gemma. As you've outlined, lasting powers of attorneys and wills are extremely important, not only to document your wishes, but also particularly in respect of wills for inheritance tax planning. And for executors, the role is not to be taken lightly. So just another prompt for questions, so please do continue to use the on-screen function. And I'd now like to introduce Daniel, who will be covering succession planning.
Thank you, Mike, and good morning, everybody. So far we've heard from Dante, Joe and Gemma regarding the changes to inheritance tax on pensions, some tax planning opportunities relating to those pensions, and most recently the importance of having an up-to-date will and powers of attorney in place. So I'm now going to talk about inheritance tax planning associated with your business and also think about some other succession planning options. As Mike explained in the introduction, the new business property relief rules, or BPR as I'll probably call them, for inheritance tax came into effect on the 6th of April this year. And that limits 100% relief to £2.5 million per person, or £5 million if you're a married couple like Bob and Margaret are in our case study. And we've seen from our case study that Bob and Margaret's shares in their trading business are valued at £6 million, which means they've exceeded their combined £5 million BPR allowance. The effect of that is that £1 million of value will be subject to inheritance tax, but an effective rate of 20%, which means they've got an IHT liability of £200,000 on those shares today. So I'm going to consider some of the options that are available to Bob and Margaret and some things they should be thinking about if they might want to sell the business in the future. So we know that if Bob and Margaret do nothing, their IHT exposure from the 6th of April next year, when the new pension rules come into force, will be £1.22 million. And this could be reduced by £100,000 by them buying the commercial property from the pension fund, as Joe explained earlier. But what should they be thinking about in respect to the company shares? They could think about transferring some of those shares to their children, Sarah and Jonathan. this has the effect of not only reducing the proportion of the company that they own, and so reducing the value of their estates, but also means that they could benefit from a minority interest discount on the shares that they keep. A minority interest discount reflects the fact they would no longer have the unfettered ability to make decisions about the company and would need to take account of the other shareholders, and those shareholders may be able to influence or potentially block some of those decisions depending on how many shares they transfer. The minority interest discount increases as the proportion of shares that you own reduces, and there are key thresholds where you would normally see a big increase in the minority discount. For example, dropping below a 75% shareholding or a 50% shareholding. So what could that mean in practice for Bob and Margaret? If they were to gift 20% of the company, the headline value of their shares would reduce from the current £6 million to 4.8 million. But in addition, they might benefit from a 10% minority interest discount, meaning the value of the shares that they have retained is not 4.8, it's 4.32 million. And as you can see, this is within their combined £5 million BPR allowance. And so assuming they live for at least 7 years following the gift of those shares, the value of their retained shareholdings would be fully covered by BPR, and so those shares would be exempt from inheritance tax. And as you can see from the bottom right hand corner, this transfer could save them £200,000 of inheritance tax, which is the 20% effective rate of IHT on the value of those shares over that £5 million threshold today. It's worth noting that the gift that is made, you'll be aware of the 7-year rule, the gift they've made is valued on the basis of the reduction in their estates and not on the value of the shares that the recipient has received. In this case, the value of their estates is reduced by 1.68 million. So the difference between the 6 million today and the 4.32 million after the gift. And this is the amount that would be brought back into their estates if they were to die within 7 years. But we'd hope that this risk would be covered by BPR, assuming the transferee still holds the shares when Bob or Margaret die, meaning there's no overall increase in their tax position as a result of taking this action. If instead of gifting 20% of the shares, they decided to give 40%, this would reduce the headline value of their shares to 3.6 million, and we'd expect a higher minority discount to apply. As you can see on there, we've indicated a 25% discount. This would mean the value of the shares they've retained would be £2.7 million, a reduction of £3.3 million compared to today. As you can see, because the value of the shares with a 20% gift would already have been below the £5 million combined allowance, increasing the transfer to 40% has no impact on today's IHT exposure. But that doesn't mean it's not worth doing. It might still be worth doing if they expect the value of the company to increase in the future, which would result in an increase in the value of the retained shares, which could mean they exceed the threshold. It could also prevent more value being in their estates if they were to sell the company before they die. So by transferring more shares now, they have more headroom for future increases in value. I think it's important to remember that if you make a gift and die within 7 years, it's the value at the date of the gift that's looked at rather than the value when you die. As I explained earlier, that value is based on the reduction in your estate rather than the value that the recipient has received. So any increase in value after the gift of that asset is outside of your estate, even if you die within 7 years. And that's why it's really good inheritance tax planning to transfer assets that are likely to increase in value. So Bob and Margaret have decided they'd like to give 20% of the company to the next generation. The question is then how to structure this. And there are essentially 2 options available to them, either an outright gift or a transfer into a trust. And each of these options has its pros and cons. The simplest option is to make an outright gift, an outright transfer. And from an inheritance tax perspective, this is also simple because there's no lifetime IHT charge irrespective of the value transferred. And there are no ongoing compliance issues or 10-year charges that I'll talk about in a bit around trusts. The gift of shares to individuals are treated as disposals for capital gains tax purposes, with the proceeds or the value received being deemed or treated for tax purposes to be the open market value of those shares. And that's even if no proceeds are received. And that means that by gifting the shares, Bob and Margaret could have a dry tax charge. So a tax charge, but with no proceeds from which to pay the tax. Depending on the nature of the company and the assets that are held by the company, it may be possible to defer the capital gain by jointly making a holdover relief election with the transferee, the person who's received the shares. But there may be restrictions on that holdover relief if there are non-trading assets owned by the company, or because of a quirk in the legislation, if the company has assets that are subject to the corporate intangible regime, generally goodwill. And that could mean that some of the gain remains taxable, even if holdover relief is available. By transferring the shares to an individual who works in the business, and I'll talk about this a bit more later, you could access more business asset disposal relief allowances, which would help on a future sale of the business, and that's currently worth up to £60,000 per person. So whilst an outright gift is simple, there are some drawbacks to it. It means there's no asset protection, there's no flexibility, and you've lost control of the asset that you've given away. The new owner of the shares can, subject to the terms of the company's articles or shareholders agreement, do what they want with the shares, and the income and capital value will only be received by that individual. It can't then be directed to other children or grandchildren or whatever tax efficiently. The value that they hold could also form part of any divorce settlement or be at risk in the event of personal insolvency. So that asset protection is not there. So what's the alternative to making an outright gift? Well, Bob and Margaret could instead transfer those shares into a discretionary trust. A trust is more complex, and the value that can be transferred into a trust upfront with no tax cost is probably limited to £2.825 million per person making the transfer, assuming that we're looking at assets that qualify for business property relief. In addition to thinking about that potential upfront tax cost, the value of the trust can be subject to inheritance tax every 10 years, but at a very low effective rate. So despite those considerations or downsides, trusts really do have some very significant advantages. The main advantages relate to flexibility, asset protection, and control that are all offered by a trust. And this is because the trust would be discretionary in nature, meaning the trustees, so they're the people who legally own the assets and can make the decisions, a bit like directors in a company, can decide when the beneficiaries receive income or assets from the trust and also when they might receive them. So if you're used to a company structure, I would think about directors being a bit like the trustees and the beneficiaries being a bit like the shareholders. So this trust structure means that, for example, the beneficiaries cannot make decisions about selling the assets, and there'll be a degree of protection in the event of divorce or personal insolvency. It also means that different beneficiaries can receive income or assets over time or in different proportions, meaning that personal circumstances, personal tax rates can be taken into account when deciding who should benefit and to what extent. So a discretionary trust offers lots of flexibility that isn't there with an outright gift. And it's often these non-tax factors that lead clients to use a trust instead of making an outright gift. In addition, you can always hold over the capital gain on a transfer into a trust, even if the company is not fully trading, and that prevents an upfront capital gains tax charge on the transfer. So we've explored the different options for gifting shares to the next generation, but what if you want to extract some of the value you've built up whilst also handing over ownership and control and the running of the company to the next generation? In this situation, you could combine making gifts, either by outright gifts to individuals or trusts, just as I've explained, but with the company buying back the balance of your shares. This means that the cash and profits that have been built up within the company can be used to pay for your shares. And that means that your children don't need to find the money from elsewhere or extract the cash from the company when that extraction would in itself result in a tax charge. And you can flex the number of shares that are gifted and retained to be bought back by the company to receive the desired value from your company. And this feeds back into the point that Dante made earlier about understanding what you need to fund your lifestyle for the rest of your lives. There are lots of conditions to be met, but assuming those conditions are satisfied, the proceeds that you receive for your shares will be subject to capital gains tax rather than income tax. And the main conditions are that you must have held the shares for at least 5 years. The buyback must be for the benefit of the company's trade. An HMRC generally consider that buying out a retiring shareholder or director is for the benefit of the company's trade, and you cannot retain a significant shareholding in the company. You can keep a small one for sentimental reasons, but not a significant shareholding. And the company must have sufficient distributable profits, so that's profits that have been earned during the company during its lifetime, to fund that share buyback. So combining these two strategies of gifting some shares and a company buyback can be a good way to pass on value and ownership to the next generation, whilst extracting the funds that you need to fund your future lifestyle. But it may be that Bob and Margaret's children aren't interested in the business and don't want to take it on and want to lead their own lives. So instead of Bob and Margaret passing the business on to their children, they may decide to exit by selling the business to a third party. From a tax perspective, as soon as they sign a binding contract for sale of those shares, business property relief is no longer available. And that will immediately increase their IHT exposure by £2.2 million on the value of those shares. That's assuming they haven't given any of the shares away beforehand. That increase may be slightly more if they've bought the commercial property from the pension fund. So if selling the business is the plan, we need to think about the tax position after the sale, and also potentially taking advantage of beneficial tax treatment whilst the shares do qualify for relief. But before thinking about tax planning, Bob and Margaret should ensure that their business is sale ready and they're going to maximise the value that they can generate. A key thing here is to make sure that the business is not reliant on them. And this might involve recruiting some new senior management who can run the business in their absence. If they do recruit senior management, it might be worth considering a share scheme, for example, to motivate, reward and retain those key employees and ensure that there's complete alignment between Bob and Margaret's interests and those new key senior management. An enterprise management incentive, or EMI scheme, is a tax efficient and incredibly flexible way to reward key employees by granting them options to buy shares at some point in the future. And these schemes can be implemented on a cashless or cash-free basis. And that means that the price the employees need to pay for the shares is funded from the ultimate sales proceeds. So the employees don't need to fund the purchase of those shares initially. And as you would expect with a tax advantage scheme, there are lots of conditions to be satisfied to be a qualifying EMI scheme, and I'm not going to cover those today. As I mentioned, once there's a binding contract for sale, business property relief is no longer available on Bob and Margaret's shares. And so some of the tax planning we talked about earlier, particularly transfers into trust, would not be available to them. So they might want to think about pre-transaction planning whilst business property relief is available. If they wait until after a sale, their options will be more limited and potentially less effective, particularly if they want to get large value into a trust. If they transfer individuals, so potentially to their, if they transfer shares to individuals, so potentially their children, more than 2 years before a sale, the individuals own more than 5% of the shares, and they are officers, so directors or company secretary, or employees of the company, they could qualify for a reduced rate of capital gains tax as a result of something called business asset disposal relief. And that could save £60,000 of capital gains tax per additional shareholder, so reducing the family's overall capital gains tax bill on a sale. So well worth thinking about, but it does need to be put in place at least 2 years before a sale. So thinking about things in advance is really important. So that's been a bit of a whistle-stop tour of some of the tax considerations around succession and exit planning. I think the key message here is that there are options available, and the important thing is to understand your financial needs so that we can work with you to make sure that your objectives are met. As you'd expect with tax reliefs, there are lots of conditions to be met, and the timing and sequencing is important. So I'd strongly recommend seeking advice as early as possible to ensure the most effective plan can be put in place. And I'll now hand back to Mike.
Thanks, Daniel. As you said, there's a number of valuable planning areas that should be considered. So just before we move on to our question and answer session, we're just going to move on to our final poll of the day, which will be popping up on your screen shortly. So following today's session, what are the most likely to do next options? And if I could ask people to select all that apply. So reviewing your tax position, pension strategy, succession planning, speaking to an advisor, or taking no immediate action. And we'll just leave that up on screen just for a few moments. Just give it a couple more seconds. So I'm going to discount the last one about taking no immediate action just for the moment, but the rest are fairly evenly spread. So so hopefully the session today has given people some food for thought. So onto our Q&A session. There'll be a slide up on the screen just again to remind people how to ask questions, and please do keep those coming in. So just to start with those, we have a question from Oliver. You mentioned using annuities. What rates are available at the moment? So I'd perhaps invite Dante to cover that question, please.
Yeah, the current annuity rates, actually, I did a quote just based on on the current ages of the people, which we talked about earlier in the case study. And you're looking around 5% at the moment, and for that and that's with a 50% spouses pension, 5-year guarantee, indexed along with RPI. I think the key point with annuities is so much is dependent on your own health. And the bottom line is that the only way you really know what you're going to get is start putting some applications in with insurance companies. And all I can say is obviously that before you have any medicals or following the application, make sure you start smoking, drink as much as you possibly can, and eat as much rich food as possible, and you're likely to get a higher rate. But certainly, joking apart, rates are considerably better than they have been, in the for the majority of my career, and I've been a financial planner now for 30 years. So it's probably a better time to think around annuities than any time in sort of fairly recent history.
Okay, thanks, Dante. Question from Jane: how can the tax that would be payable on business assets be funded, or could the beneficiaries of my estate be forced to sell business assets to fund inheritance tax liabilities? Daniel, perhaps you'd like to pick that one up.
Yeah, thanks, Mike. I think this has obviously been a real concern since the rules were announced back in October 2024. I think a really important point to note is if you've got assets that qualify for business property relief, but you're over the £2.5 million allowance, any tax that is payable can be paid over 10 years by instalments, and there's no interest charged on that. So that helps with the funding of it and the cash flow, and hopefully eases some of that concern around having to sell assets to fund the tax. If you've got shares in a company, potentially one of the options is for the company to buy back some shares out of the estate and use the company money to fund that inheritance tax. And that's the same company buyback of shares that I talked about earlier. So that can be very tax efficient and mean that the money in the company can be used rather than having to sell things to third parties. So it's using the money in the estate to fund the tax. So hopefully that reassures you in terms of the payment of the tax and where the cash can come from.
Thanks, Daniel. One from Jessica. My current will includes a BPR trust, so Business Property Relief Trust, rather than leaving qualifying assets to my spouse. Is it okay to keep this, or should I remove it? Perhaps Gemma, you start with an answer on that.
Sure. Well, ever the lawyer, I think I'll sit on the fence and say it depends on your personal circumstances as to whether it's right for you or not. But potentially it could still work. It probably depends on the value of the business assets. We've heard from Daniel that it's only the first 2.5 million that would get 100% relief. So that's something to watch out for if you don't want inheritance tax payable on first death. But it could potentially be quite a useful way to bring down the value of the survivor's estate to get back within the threshold for the residence nil rate ban. So it could be quite a useful one. I don't know if Daniel or Joe wants to chip in from a tax perspective.
Yeah, I think I'd add that if the plan is to sell the company at some point, so on the second death, the assets won't be qualifying for BPR or business property relief, then actually leaving the shares or the business asset into a trust means that the value would not be subject to inheritance tax on that second death. So I think BPR trust can still play a really important part. And as you say, it could bring you below the threshold for the residence nil rate band.
Okay, thank you. Question from Michael. So with regard to gifts out of excess income, are capital purchases deemed as expenditure? Joe, perhaps you could pick that one up, please.
Yeah, sure, Mike. I think the key point really here is the fact that it has to be normal expenditure out of income or regular expenditure out of income. So what habitually does that individual, their expenses look like? Typically speaking, one-off capital purchases won't qualify. So if you buy a house, you don't typically buy your cars, that sort of thing. You would exclude from calculating what your surplus income is. However, if you are somebody that replaces your car every year, or you've got works being done to your property and that's an ongoing cost, then it could fall within that definition.
Okay, thanks, Joe. A challenging one here, perhaps for Dante. So what do you feel will be the next change to pensions, Dante? Get your crystal ball out.
Well, yes, I mean, I remember back in 2006 when we had pension simplification, and that was meant to be, you know, the end of it, because it was pretty complicated, the rules before. And then I think within a couple of years, it was all change. And I think there's always talk every year about the tax-free part of a pension being taken away. I just think that's probably going to go on the too difficult pile and complicated. And I mean, if you think about what actually caused the biggest leakage to the Treasury immediately, it's actually a tax relief on contributions that people are making. And if I was to make one prediction, it would be that perhaps they might decide that they'll limit the tax relief on pension contributions to, let's say, basic rate for everyone. Yeah, and we can already see that you've got salary sacrifice schemes being attacked in a number of years. So I suspect there is going to be a change. It's going to be around the tax relief you get on contributions. But with the current government being desperate for money, I suppose, or future governments being desperate for money, I suppose you could argue nothing's off the table.
Yeah, exactly. Thanks, Dante. One from Yasmin here. So please, can you explain more about the inheritance tax benefits of taking money from my pension rather than taking dividends from my company? Perhaps Dan or Joe would like to pick that up.
Happy to. So as I mentioned earlier, if you replace income from a business property relief qualifying asset from an asset that would be subject to inheritance tax, you are shifting that balance between the two. So taking Yasmin's specific question, drawing income from my pension, which is going to be a taxable asset in my estate going forwards, you're reducing your inheritance tax position at a rate of 40%. If I'm therefore stopping the income coming out of my company, the value of my company will go up, which is subject to business, or could be subject to business property relief, and therefore the maximum rate of inheritance tax I will be paying is an effective 20% tax. So there's an immediate inheritance tax saving with that offset. I would, however, caveat the points that I mentioned earlier, that specifically around business property relief qualifying assets, if you do have a large buildup of cash in your company and you cannot demonstrate that there is a business purpose for that money, and that's got to be a relatively short-term business need, then you could be restricted on the amount of business property relief you would be able to claim in the event of a lifetime gift or on your passing.
Okay, thanks, Joe. So question from Michael, with regards to minority discounts on shares, are a husband's and wife's shareholdings aggregated in calculating the discount allowable? Daniel, perhaps you can pick that one up.
Yeah, thanks, Mike. That's a really good question. So for inheritance tax, or the inheritance tax rule includes something called related property. So you have to look at husbands and wives together to determine the value of the asset. So if in our example, Bob's got 27% and Margaret's got 25% of the company, they'll own more than 50%, and therefore they've got a controlling interest together, and that's what would drive the minority discount that would apply to their shares. So that's in a negative sense, that you combine them and you get a lower minority discount based on their joint ownership. But Joe earlier talked about the use of the commercial property. If that's owned by them personally, as long as between them they control the company, then whichever of them owns the commercial property would get 50% business property relief. So there are some advantages of combining their shareholdings, but also some disadvantages when you come to valuation. So that's something that we'd need to look at carefully.
So each case on its own merits, really.
Yeah.
One from Andrew. So for Gemma to answer, when is it worth appointing a professional executor, Gemma?
Well, I mean, you can see how much more complicated it's become. So I think for a lot of people, they'll probably be quite nervous to take on that role. So it could be that a professional executor could be really useful if you have people who just don't feel that they'd have enough time to be able to commit to the administration, or because perhaps your beneficiaries are just too young to take on that responsibility just yet. So it could be an interim measure, and then as your children are older, they could step in and take over that responsibility, and you could update your will to include them as executors. Or it might be often people worry about the need to have sort of someone independent and end up appointing, I don't know, their nephew who is a retired accountant or something, and think, oh yeah, that would be a good idea. But given the amount of work involved, if they're not a beneficiary of your estate, it's an awful lot to place on somebody who can't actually charge for the work that they do. So I'd be thinking about a professional if you're really intent on having somebody independent, so that they can at least charge for the work that they do, and that you know that they'll get the job done.
Yeah, I think we touched on earlier, Gemma, it's not a role to be taken lightly, is it? And actually, probably the other point is if you are appointing executors, probably have a conversation with them whilst you're still around, so they know that they're executors. So a question from Philip. Does an Airbnb jointly owned with a spouse count as a business in respect of business property relief? Joe, perhaps you could pick that one up, please.
Yeah, of course. I think the straightforward answer is no. Airbnb is the letting of property, and whilst it may have qualified as a furnished holiday let in the past, which gave some quite attractive tax reliefs, those rules have ended now. So unfortunately, you're not going to be able to claim it on that property or properties if you've got multiple.
Yeah, okay, thank you. So one from Stephen, you mentioned pension providers not being ready for these changes in April 2027. Can you just sort of clarify a bit more what you meant by that, Dante, please?
Yes, the issue is for most of the pension providers, obviously from running their own businesses, they don't tend to have a huge department which is dealing with effectively what they would view is money out. They're going to have a much larger department dealing with money in. And a lot of the providers have problems with legacy systems. So they find it difficult to get valuations out in a timely manner. And obviously they're going to be wrestling with these new rules. And we know that come April 2027, most of the providers are going to be absolutely inundated with changes to expression of wish forms. And bearing in mind what I first said is they don't tend to have large departments which concentrate just on death benefits, and some providers don't even have a death benefit department. We feel that some of the providers out there, certainly some of the legacy providers, are likely to really struggle and fall over. And it's going to put, I think, people into difficult situations where tax is due, but they don't even know what the tax is due because they haven't had the valuations yet. So I hope that there'll be some leniency from HMRC, but we'll see.
Yeah, we'll have to wait and see, won't we? It's going to be, an interesting challenge. This may be a follow-up question to that, actually. So if there's one thing to do now, what would it be, Dante? I don't know if that was specifically in relation to pensions or the wider planning point.
I mean, I think we'd get advice. And pensions really should not be looked at in isolation. It's take advice on your whole estate. And from my perspective, it's really important that we work with other professionals, from our colleagues in accountancy and law. It is very, very complicated when you really start to get into the detail, as you can see from this presentation. So yeah, just please take advice. Don't leave it to chance. If you don't have a plan, you'll be subject to someone else's plan. That's the key message.
Yep, no, good point.
I think what I'd add there, Mike, is understand what your potential inheritance tax exposure is. I think we see a lot of clients who either wildly overestimate it and panic and think they've got a much bigger problem that they have, or are completely ignorant of what their liability is. So I think doing a personal balance sheet, understanding what your assets are, quantifying what your potential inheritance tax exposure is, and as Dante said earlier, think about what you want to be able to do and fund through your lifestyle. That will give you a really good feel for what you need to retain, and then that gives us some ideas about what we can do to try and mitigate that inheritance tax exposure. But I think understand where you are today and think about where you want to get to. That will shape a lot of the discussions that we would have, whether that's from a tax, legal or wealth perspective.
I think in addition to that, I'd probably just add doing a sort of asset summary calculating inheritance tax also gives a bit of a steer to executors to know what you've got. So because by definition, if you're no longer around and they're appointed, it can be quite a challenge in tracking all the assets down. One from Isabel. So are there any tax benefits to acquiring the commercial property being purchased by Bob and Margaret's company rather than by them personally? Joe, perhaps you can pick that up.
Yes, of course. In Bob and Margaret's case, no, because their company, Nexora Trading Limited, qualifies for 100% business property relief already. So the cash in there that they do have available to buy the property, you'd be swapping a cash balance for a property balance with no immediate inheritance tax difference. If the company did have excess cash and therefore business property relief could be restricted because of that rule, then yes, there could be a benefit to acquiring it in the company. I would caveat that in respect of succession planning though, because we do see a lot of businesses when they're being acquired, the acquirer doesn't want the property, they just want the business, and therefore there's some tax and other issues that we'd need to work through to separate out the two longer term. So that decision about extracting the property from the pension to your company needs to be considered alongside the wider succession planning point.
Lovely, thanks, Joe. Interesting question. So how do you balance tax planning with maintaining control of the business? So Dan, you mentioned about gifting shares and using all sorts of structures. Perhaps you can cover that.
Yeah, I think it's a really valid concern, and one that lots of clients have, that they're perhaps willing to give away value to mitigate their inheritance tax and pass value on to the next generation, but they want to keep control close to their chest. So there are a number of ways that can be achieved. So I talked earlier about potentially gifting shares into a trust. With the trust, the person who sets up the trust, the settlor, can also be a trustee, so they can be the ones who make the decisions during their lifetime about what happens to those shares and how dividends are used, or if and when a company is sold. So they can retain control through that, but have given the benefit to beneficiaries and removed the value from their estate. The other thing we see quite a lot is people putting in bespoke articles of association. So that's the company's constitution that governs how it's run, and that can restrict or limit decision making, or mean that decision making remains with the founder shareholders. The downside of that is that probably increases the value of their shares, because they've got more control over the company, and so minority discounts might be lower. And or they could put in place something called a shareholders agreement that governs who makes the decisions and how those decisions are made. So again, they can retain control or require a 75% majority for certain decisions and things like that. So there are probably three ways that we see that being governed. And going back to the articles of association, it may mean they have different class of shares that have slightly different rights as well. So I think it's achievable. It comes back to my previous point about understanding what's important and what people are concerned about, to make sure that we can put in place the appropriate structures and measures to provide that control whilst saving some tax.
I'd also add to that as well, Daniel, that there's two types of control. There's director control and the shareholder control, and I think there is a lot of misconception about what the two differences are. Some clients are happy just to influence the day-to-day decisions of the company, in which case being a director or maintaining directorship is potentially enough. Because shareholder control is limited to an extent. So I think it's just about understanding the two and making sure you're comfortable with what that control looks like for you as an individual.
Yeah, I think that's absolutely right, Joe. And I think a key thing that we see in either the articles or the shareholders agreement is who gets the right to appoint the directors or remove directors and things, and that feeds into that. So yeah, it's a really good point.
Lovely, thanks both. Question for Dante here. So you mentioned about life assurance in trust. What type of cover is best, and how much is it likely to cost? Which I appreciate will be a difficult question to answer, but over to you.
Yeah, you've got different types of cover depending on what you're doing. If you're making a gift and you want to make sure the inheritance tax liability is covered for that 7-year period until the gift's out your estate, you can use something called a gift inter vivos policy, and those premiums tend to be relatively cheap. If I'm just looking here at a quote here, for example, if you've got £100,000 of cover, 65-year-old in good health, it's about £30 a month. So it isn't exactly expensive. If you're looking to, your long-term inheritance liability, you need to take out something called a whole of life contract. Currently rates, if you want, yet again, a 65-year-old, assuming in good health, it's about £180 a month for £100,000 of cover. For those of you who do have existing life policies, whole of life policies, just be really careful the type of policy you've got. There was certainly 10, 15 years ago when a lot of policies were taken out. They were sold on what we call a reviewable basis. And what that means is that the policy, you get to a certain age and a policy is reviewed. And they look at the sum assured, and they look at the potential, the growth of the contract to date. And what we're often seeing is that they will say to her, if you wish the current sum assured to continue, the premium will rise considerably, or if you want to keep the premium as is, the level of cover then drops considerably. Those aren't really very helpful when it comes to the point of view of you're trying to perhaps insure a known liability, but the insurance amount that you have is variable. So those policies should be reviewed.
Thank you, Dante.
Mike, can I just add
yep.
there from an inheritance tax point of view, we would want those policies written in trust rather than being either into your estate or left to your spouse's estate. Otherwise, the proceeds themselves will be subject to inheritance tax. And if you're paying premiums on a life policy that is written in trust, those will be gifts for inheritance tax purposes, unless it's within the gifts out of income exemption that Joe talked about earlier. So if the premiums suddenly ramp up, as Dante talked about on a review, it may be that you don't have the surplus income to cover those premiums anymore, and that may start being a gift itself that's subject to the 7-year clock. So just some other factors to think about. But if you've got a life policy, dig out the paperwork and see whether it's written in trust.
The other thing is, I would say, is though a lot of life insurance companies do provide their own trusts, we always recommend that you get independent advice rather than relying on a life insurance company trust.
And can I just interject that if it's not in trusts, speak to somebody before you think, right, now let's stick it in a trust, because that could also incur a tax liability if you're not careful. So speak to someone.
Good points. Thank you, everybody. Final question. Should business owners have separate lasting powers of attorney for business affairs and personal affairs? So, Gemma, that's probably for you.
Well, that's probably a topic for a seminar in itself, actually. But it is possible to have multiple powers of attorney. So, yes, if you don't want your business partner also making decisions about where you live, it might make sense to have a separate one, but it is worth bearing in mind that, as Joe and Daniel pointed out earlier, the Articles of Association might have points on who can be appointed as a director and what happens on incapacity of a director. So it all needs to be tied in, and they need to complement one another. So you would need to update the documents probably at the same time to make sure that they work.
Lovely, thank you, Gemma. So I'm just going to bring the Q&A session to an end now. So thank you everyone for your questions and to our panelists for their insightful answers. If your question wasn't answered live, rest assured that one of our experts will follow up with you after the webinar. And if there's anything else you'd like to discuss, please do leave a note in a pop-up survey at the end and we will be in touch. If you could please just take a moment to complete our short survey. Your input will help us shape and improve these webinars and events for the benefit of you. And just to wrap up in summary, just so a few action points to take away. Consider your own circumstances and needs, both now and in the future. So that encompasses cash requirements. Remember peace of mind as well. Seek advice. Use your joint advisory team. So whether that's covering tax, legal, wealth, etc. Review your pension arrangements. Get your affairs in order now. Review your wills. Make sure you've got some current wills and powers of attorney in place. And finally, just ensure that you have a plan in place and review it on a regular basis. So thank you all for attending. We hope you found this webinar useful. Enjoy the rest of your day. Thank you again and goodbye.